Alrighty guys, what is going up? I hope you guys are all having a great and amazing day today. Now in today's episode, we're going to be talking about Spotify. Ticker symbol SPOT. I hope you guys enjoy it. And if you guys get anything in value, make sure you guys hit that like button, subscribe to the channel, and go ahead and check out my course. Honestly, we talk about how to properly invest in the stock market. We do talk about fundamental, we do talk about technical analysis, we talk about taxes, retirement, and how to find undervalued stock. Make sure you guys check it out. It's $5. It's the first link down below. So now let's jump into it. Roll the intro. Let's go. So we all know Spotify as being that media and music streaming service that people go to listen to music or to listen to a podcast. And the company's growing at a very, very rapid rate, but I do think they could possibly be the next Netflix. Let me explain with some fundamental and technical analysis. Now, honestly, Spotify does have two main ways of revenue. The very first way is ads. Now, this is when you guys listen to that annoying 10-second ad before you listen to some music. Now, this makes up around 9% of all Spotify's revenue, which is quite a bit. Now, this next number is gonna blow your head off. Now, this is the second way Spotify makes money. This makes up around 91% of all their revenue. This is nuts. This is Spotify Premium. Now that's that subscription model where you pay like $9 or $10 a month to have no ads and you get some extra songs. Now this makes them a ton of money because their last revenue statement, they made around $2 billion, and this was an overall 11% increase, which is really, really strong for this time of uncertainty. They're still doing very, very well. Now the company does have negative margins. Their margin rate is negative 4%. Really what that means is for every $100 they bring in, they actually lose about $4. It's not that big of a deal because there's a ton of companies that aren't profitable yet. We had Tesla just become profitable. We have Roku, that's not even profitable. But honestly, when you invest in a company, you're investing in for the long term. That's the way I look at it, so it's not that big of a deal for a company not to be profitable yet. Now they do have around $1.9 billion in cash, which is great because this is an overall 17% increase. So really what this means, why I love cash on hand so much, is because when a company slows down and they're not making as much money, they can still use that cash and grow it. Because that's the biggest thing. When we have economic downtime and downturns, a company needs cash to stay alive. Cash is king. Why do you think Apple has so much cash? Now, why do you think Microsoft has so much cash? Because they are ready for downturns. That's pretty much it. Now, another thing I do like to look at is long-term debt. Long-term debt is one of the best ways to evaluate a company. When you have a company that has an ungodly amount of long-term debt, you have to look at, well, how are they going to pay that off? Why do you think Ford is getting slammed? Ford makes the most trucks in the United States, but their long-term debt is off the charts. This company, their long-term debt is not that big. It's around $700 million, which it's not that big of a deal. It really isn't. Because, I know that they could eventually pay that off and the cash on hand outweighs that long-term debt. That's a little ratio I do like to use. Now, another thing, Spotify is definitely taking over the podcast market. Now, the reason why I say that is because they are picking up a ton of top podcasters. They picked up Joe Rogan, they picked up Addison Rae, and those two alone make up a ton. Now, they did pay Joe Rogan, I think, around $100 million, but honestly, I think they're slowly separating themselves from Apple and a lot of the other podcast stations. Now, those people are exclusive with Spotify alone, which is overall going to get Spotify more traffic. Now, another reason why I love this stock so much is because the paid user base is growing at around 31% each year, which is really, really good. That is that subscription model like I talked about earlier, where people don't have to listen to ads and they get extra songs. That's growing at 31% per year, which we all know, subscription model, you make around 3 times more than you would with just one standard fee. So in the long run, they're gonna make a ton of money, and that's why I like to compare them to Netflix. But honestly, let's go ahead and look at some technicals. Let's look at support, resistance, and where I see the stock in the future. Let's go. Bye. Alrighty guys, so we have ticker symbol SPOT. This is Spotify. So you guys can see that this stock does have some clear resistance at around $200. Clear support at around $100 per share. Now, lately, this stock has just absolutely exploded up, hitting highs, forming some new resistance at around $300. That's what I like to call that resistance, just because we did get multiple hits once here, almost hit it here, and then we just got some sell off here. Now, looking at the stock, you guys can see that it really just consolidated here and then explosion. Now, looking at this little explosion area over here, now you guys can see that it looks like it did find some support at around $231 per share. So that is that new support for this stock. Now, looking at long-term and over or undervalued price points, so let's look at the RSI for that. Now, when a stock is trading at, above a 70 on the RSI, this states that it's overvalued. When it's at around a 30, it's undervalued. It's a clear momentum indicator that I like to use to get a good idea of where the company is at and could go. So when it's trading at a 59, that's just kind of a perfect middle ground. And now looking at it like this, well, the stock just hit some support. So now we're climbing back up. So I do think that this stock could definitely go from around 250 back to around 285. That's kind of my little price target, and honestly, my little swing trade that possibly could be there. But overall, what is my price point to buy? Honestly, I do like this support at around 230. I think that's a very, very fair evaluation for this stock. Now, where's my future price target? Where do I see it by mid next year? I do see it at around $410. I do think that gives it that 31% growth, and I do think that gives it becoming profitable very, very soon. I think the long-term and short-term potential for this stock is very, very strong, and I'm excited to see what happens with it. Honestly, when investing into a company like this, should you do one lump sum? Well, one lump sum works great when it's at a hard support. So one lump sum at 230 could definitely pay off. But when investing into something like this, I think it's always smart to use dollar cost averaging. So taking $1,000 instead of one lump sum, you spread out that monthly payment, maybe like $100 per month over the next 10 months. Really what you do is you just get a good overall average price. You drop that risk down, and overall you just make more money in the long run doing it, especially with these high growth, high volatile stocks. So that is it though. I hope you guys enjoyed the episode, and if you guys did, make sure you guys smash the like button, subscribe to the channel, and go ahead and check out my course down below. It's $5. It's definitely worth it. We'll see you guys tomorrow. Take care. Remember to stay happy, stay positive, and overall stay safe out there. We'll see you guys tomorrow. Take care. Bye.